I would like to start this video out with a quick apology. Not for it taking me almost a week to produce a new video, but for the reason it took me a week to produce a new video. After my presentation last week, where I presented some possible practical withdrawal strategies, I got to work determining tax implications of those strategies. As I was doing the work, I noticed some things that did not make sense to me, and so I did the natural thing and searched the new work for errors. After days of searching, I didn't find any. And just when I was about to give up, I found an error in the work upon which my last video was based. There was a formula error in the spreadsheet used to determine the performance of the 65% 35% stock versus gold mix, whereby the withdrawal strategy was to sell the asset that was above its target balance. What I am showing here is a corrected version of the final slide of my previous video. As you can see, the result is quite surprising. If we start out entering the 1970s with a $100,000 CPI adjusted portfolio consisting of 65% stocks and 35% gold, the portfolio would have supported a 6% withdrawal rate over the past 5 decades, and the final value would have been the same as the initial value. At least this is the case if the portfolio is not rebalanced continuously, but sales only made of the asset that's above its target allocation. This 6% is quite astounding, because it is even higher than the 5.6% withdrawal rate that could have been supported by the continuously rebalanced portfolio. I would have been very skeptical of this result had I not spent countless hours making sure that the conclusion is correct. And one has to wonder why this should be so. And the answer comes back to this graph, where I showed that the negative correlation between financial assets and gold strengthens over time. Thus, the longer the period of time the assets in the portfolio are held without rebalancing, the more the gains in one asset will offset the losses in the other. This is the reason why Monte Carlo simulation won't work. Finding that simply liquidating the asset that is overweighted results in superior returns is really quite a happy finding. First, it greatly simplifies the asset location problem. It allows physical gold to be held outside of the financial system, while financial assets can be held in a combination of tax-sheltered accounts and taxable accounts. Second, it will greatly reduce the impact of tax and cost drag of the rebalancing process, which is the subject of this video. So with that said, let me pivot to that subject. Let's start our tax discussion with a hypothetical example of an asset that appreciates in nominal price by 9% per year continuously. For this asset, no taxes need to be paid. The asset is held over a 30-year period in which the rate of CPI increase is 4% per year. We can see that the real purchasing power of our asset increases nicely. For every $1,000 invested in year 0, we'll have $1,599 of real purchasing power after 10 years, $2,558 after 20 years, and $4,091 after 30 years. Certainly inflation has taken its toll. After all, a 9% per year real gain would result in our $1,000 becoming $13,268. But we're left with less than a third of that. Such is the nature of the illusion that is the continuously shrinking dollar. But what about taxes? We haven't even paid taxes yet. Well, the impact of taxes depends quite a bit on how frequently they are paid. Let's assume that we only pay taxes once upon liquidation. So in this case, we assume that we have to pay 20% when we liquidate the asset. This can be federal tax, state tax, transaction costs, or a combination of them. Notice that even if we pay taxes only at the end, we still lose quite a bit of value. If we hold for 10 years, then we'll have $1,415 of real after-tax purchasing power, as opposed to $1,599. If we hold for 20 years, we'll have $2,138 of real after-tax purchasing power instead of $2,558. And if we hold for 30 years, we'll have $3,334 instead of $4,091. So we can see that taxes can take really quite a big chunk out of returns. But this isn't even the worst of it. What if we pay taxes each year instead of at the very end of a holding period? This would represent the extreme in the event that a person needed to rebalance every year outside of a tax-sheltered account. Here's what that would look like. Look at how much value was given up to taxes when they are paid every year. At the end of 30 years, we're left with $2,482 of real after-tax purchasing power. Just so that we're clear, let me remind you of the other outcomes. In an inflation-free and tax-free world, we would have had $13,268. Inflation reduced it to $4,091. Paying taxes each and every year on the gains, which, by the way, are nominal gains and not inflation-adjusted gains, makes us down to $2,482. Think about this for a minute. The tax rate is 20%, but at the end of 30 years, the difference between paying no taxes and paying tax continuously on the realized gains is $1,609. That 20% tax rate took about 40% of your total after-tax wealth and 52% of your after-tax gains. Let me say that one more time so that everyone understands. By continuously realizing gains and paying the tax on the gain, what could have been a 20% penalty turned into a 52% penalty. Why so high? It's the inflation component. Remember, you have to pay tax on the nominal gains, but you only get to spend the real inflation-adjusted gains, after tax, of course. Thus, since you are essentially paying tax on both the real gain as well as the inflation component of the gain, you get hit hard. And it gets worse the longer you do it. This is one of the primary reasons why transaction frequency should be minimized if you are making adjustments outside of a tax-sheltered account such as an IRA or 401k. Now let's see how this translates into what we get to take home from the 65% stock, 35% gold portfolio, depending upon how we decide to manage it and spend it down in retirement. Let's see what taxes do to a 65% stock, 35% gold portfolio that's continuously rebalanced. This is what's happened over the past 5 decades, where we set the percentage rate of sale to be such that the beginning withdrawal rate is about the same as the end. We already know what happened if there were no taxes to be paid. And look what a dramatic difference there is in the world of taxes. Rather than selling 5.6% of the assets every year and living off of the proceeds, our investor in the world of tax could only sell 4.9% per year. Wait a minute, Blank Pete, that doesn't make any sense. It should be the after-tax figures that change. Whether or not you are paying taxes shouldn't change the percentage that you sell every year. But it does. I assumed that at the beginning of this period of time, the investor had a 100% cost basis for all of the assets in the portfolio. Thus, at the beginning, the investor paid very little in tax. As time wore on and inflation took its toll, the cost basis eventually became insignificant, leaving the investor to pay the full burden of taxes. Thus, the withdrawal rate needed to be adjusted downward to prevent the CPI-adjusted after-tax spending at the end from being significantly lower than it was at the beginning. Just like the previous slide would suggest, the median after-tax spend is significantly lower than if there were no taxes. The median income, when taxes are taken, is 36% lower. This despite a tax rate of 20%. Remember, we are continuously rebalancing, and so we are continuously paying taxes on assets that are higher in price than what we paid for them, even if most of that apparent gain is just the effect of inflation. Now, as much as that is a problem, that's not the biggest problem that I see. Notice that the available spending is now highly erratic. There are some years where the act of rebalancing the portfolio results in such large gains being realized that the taxes to be paid are actually higher than the amount of money being withdrawn. You'd spend more in taxes than you could withdraw from your portfolio. Obviously, the continuous rebalancing approach to managing the portfolio doesn't work too well unless you do it inside of a tax shelter, and then you'd be stuck with paper representations of gold. Let's see what happens when we just adopt the sell whichever asset is highest approach to the target allocation management. And here it is. If you recall on my first slide, I found that the withdrawal policy of liquidating the asset that was above its desired level performed better than the one which was continuously rebalanced. The level of outperformance, it turns out, is not quite high enough to pay the taxes on the gains, but it comes pretty darn close. A continuously rebalanced portfolio without tax could have sustained a $407 per month CPI-adjusted withdrawal rate per $100,000 invested. The portfolio policy that just sells the overweighted asset could sustain a $388 per month CPI-adjusted rate of withdrawal per $100,000 invested without depleting the portfolio. But the key here is that $388 per month is after tax and is only 5% lower than what could have been accomplished with the continuously rebalanced portfolio in the hypothetical world of no taxes at all. This is quite surprising, but as I mentioned earlier, I did comb through all of the formulas for many hours, and I've satisfied myself that this result is correct. And all of this is the benefit of the negative correlations between stocks and gold becoming more strongly negative over longer holding times. I'd like to make sure to mention that all of this is based upon the past 5 decades worth of data. In an uncertain world, prudence dictates building in some margin of safety. Anyone who adopts this approach would be well served doing what I am planning to do, which is to take less than what history indicates is the maximum. I myself am thinking 3.5% to 4% is probably safe, provided it is 3.5% to 4% of the portfolio value each year, and not 3.5% to 4% of the portfolio initial value at the beginning of the retirement. That way, the drawdowns will be reduced. So I hope this video has been interesting for all of you. I look forward to our discussions. Thanks for watching. I would like to start this video out with a quick apology, not for it taking me almost a week